It was once the great Australian dream. A home on a quiet street, a patch of lawn out the back, the iconic Hills hoist spinning in the afternoon sun. Home ownership wasn't just about shelter, it was about security, identity, and progress. But in 2025, that dream is turning into a financial nightmare for millions of Australians. From Sydney's outer suburbs to regional towns once seen as safe havens, families are now under immense pressure. Bank letters are becoming more urgent, savings are vanishing, and conversations around the dinner table are filled with quiet panic rather than plans for the future. In one of the wealthiest nations on Earth, mortgage stress has become a silent epidemic, chipping away at stability, mental health, and hope. This isn't just a housing affordability problem. It's a reckoning, a collision between what we were promised and what we're actually living. Let's unpack what's really going on. What is mortgage stress, and why now? In basic terms, mortgage stress happens when a household spends more than 30% of its gross income on home loan repayments. That's the traditional benchmark. But in 2025, that definition feels almost quaint. Because in today's Australia, 1 in 4 mortgage holders is spending well over that threshold. For many families, it's not 30%, it's 40%, sometimes 50%. A report by Digital Finance Analytics earlier this year estimated that over 1.6 million households are currently in mortgage stress. That's more than 1 in 3 borrowers, and the numbers are rising month by month. What changed? Interest rates, for one. The Reserve Bank of Australia kept rates historically low for years. In 2021, you could borrow money at under 2%. That made home loans feel manageable, even on high purchase prices. But those days are gone. Between May 2022 and late 2024, the RBA lifted the cash rate from 0.10% to 4.35%, one of the fastest and most aggressive tightening cycles in modern Australian history. And the impact has been brutal. Take Amanda and Jason. They're in their mid-30s with 2 young kids. In 2021, they bought a modest 3-bedroom home in Melbourne's outer suburbs. They were careful. They stayed within their budget. Jason's a tradie. Amanda works part-time in childcare. Like many young families, they locked in a low fixed mortgage rate, just under 2% for 3 years, thinking it was the smart move. And at the time, it was. But fast forward to 2025, and that fixed period has ended. Their loan has now reverted to a variable rate of around 6%. They didn't default. They didn't miss a payment. They just hit the end of the deal. And now their repayments are up 60%. They're burning through savings just to keep the house. Jason's working weekends. Amanda thought about quitting her job to save on daycare costs, but losing her income would only push them further behind. And they're not alone. In Sydney, young professionals are skipping meals and canceling insurance policies just to meet mortgage deadlines. In Perth, retirees who borrowed against their homes to help their adult children are now facing serious reverse mortgage risks. In Brisbane, first home buyers are quietly listing properties for sale only 2 years after buying, hoping to break even before falling behind. Mortgage stress doesn't always look dramatic. It's not necessarily foreclosure. It's quieter than that. It's anxiety. Sleepless nights, maxed out credit cards, the constant background noise of dread. That sense that you're just one unexpected bill away from going under. The role of wages and inflation. It's not just rising interest rates causing the pain. The real pressure comes from a toxic combination: stagnant wages, rising living costs, and a housing market that has run ahead of reality. For more than a decade, Australian wages have barely moved in real terms. Between 2012 and 2022, average full-time weekly earnings increased by just over 30%. But in that same period, median house prices in cities like Sydney and Melbourne doubled, or in some cases did even more. That gap between what people earn and what housing costs has become a chasm. Then came the post-pandemic inflation wave. Groceries, fuel, electricity, insurance, it all went up. The average weekly grocery bill for a family of 4 was around $230 in 2020. In 2025, it's pushing $350. Electricity bills have risen by 25% since 2021, while insurance premiums, particularly home and contents, have jumped due to climate-related disasters. Even if your mortgage repayments hadn't risen, your disposable income would still be shrinking. But combine high repayments with soaring household costs, and many families are trapped. They're not living beyond their means. They're trying to live within a system that keeps moving the goalposts. Mortgage stress isn't just personal mismanagement. It's structural failure. Who's most at risk? It's tempting to think this is only hitting low-income households, but mortgage stress in 2025 is cutting across class lines. Middle-income earners in urban areas are among the most affected. Why? Because they were encouraged by banks, by policy, by culture, to take on large loans during the low-rate era. In fact, data from CoreLogic shows that over 40% of new loans issued in 2021 were at a debt-to-income ratio greater than 6. That's the level many economists consider risky. Younger buyers are also disproportionately affected. Millennials who bought in the last 5 years now face higher rates, falling property values, and zero equity buffer. If house prices fall even slightly more, some will find themselves in negative equity, owing more than the home is worth. And then there are regional borrowers. They rushed into the market during the COVID work-from-home shift. Towns like Ballarat, Orange, and Toowoomba saw massive price surges. Now, some of those gains are reversing, but the debt remains. Even dual-income households with good jobs are starting to sweat. Because stress isn't just about income level. It's about the ratio between income and debt. And in that measure, a lot of Australians are in deep water. The mental and social toll. Mortgage stress doesn't show up on your front lawn. There's no sign in the window, no flashing alarm, but it leaves a mark on minds, on families, and on entire communities. Mental health professionals are warning of a quiet surge in anxiety and depression directly tied to financial stress. Lifeline Australia reports that calls mentioning housing stress have doubled since 2022. The pressure to keep up with rising mortgage repayments is forcing people to make heartbreaking choices. Many are skipping GP visits, canceling therapy, delaying dental care. Even basic preventive health becomes a luxury. But it's not just about money, it's about dignity. People are ashamed to admit they're struggling. They avoid social events, say no to birthday dinners or outings. They pull away just when they need connection the most, and the impact spreads. Teachers report more children turning up to school without lunch. Parents are working longer hours, sometimes multiple jobs, and still falling behind. Community groups lose volunteers. Sporting clubs lose members. Small businesses suffer as households tighten their belts. Mortgage stress isn't just a personal financial crisis. It's becoming a public health issue, eroding social bonds and community life across the country, quietly but steadily. So where's the help? The federal government is well aware this mortgage stress crisis is growing, but its options are limited, and its responses so far have been piecemeal. Housing affordability is a deep structural problem that can't be fixed overnight. Increasing supply, reforming zoning laws, improving planning systems, and building more public or social housing are all part of the solution. But these take years, not months. Meanwhile, the Reserve Bank is still prioritizing its fight against inflation. That means keeping interest rates high, even though it's clear those rates are putting intense pressure on mortgage holders. The RBA's balancing act may be economically necessary, but it's also socially damaging. Yes, there are some relief measures. States have mortgage hardship support programs. The federal government announced a $500 million housing support package in 2024, including rental assistance and subsidies for low-income buyers. But in the context of a $10 trillion housing market, that's a drop in the ocean. Banks offer temporary solutions, pausing repayments or switching to interest only. But these are band-aids, not cures. They offer short-term relief while increasing long-term debt. Policymakers are walking a tightrope, trying to cool inflation without plunging households into financial ruin. And right now, millions of Australians are the ones holding their breath below. So what happens next? There are 3 possible paths. None of them are simple. Scenario 1. A slow burn adjustment. In this version, mortgage stress remains widespread but doesn't spiral into a full-blown crisis. Households gradually adapt, cutting back on discretionary spending, taking on extra work, or dipping into savings to stay afloat. The government introduces modest support measures, and the Reserve Bank cautiously eases interest rates as inflation stabilizes. While financial pressure persists for many, the system holds. It's uncomfortable, unsustainable long-term, but it avoids a catastrophic collapse. Scenario 2. The tipping point. Here, rising delinquencies begin to tip vulnerable households into foreclosure. As more properties are forced onto the market, prices start to fall, triggering a dangerous feedback loop. Homeowners slip into negative equity, more distressed sales follow, and mortgage stress deepens. Confidence in the housing market falters. Banks tighten lending criteria. New construction projects are delayed or scrapped. Consumer spending drops. Business confidence weakens. What started as household stress becomes an economy-wide downturn. This is the recession risk. Scenario 3. Structural reform. In the most optimistic path, Australia uses this moment as a wake-up call. Governments and banks work together to reshape housing policy, shifting incentives away from speculation and toward affordability. Major investment in public housing, zoning reform, and first home support follows. The definition of home ownership shifts. Renting becomes more secure and respected. Debt levels moderate over time. And the great Australian dream becomes less about owning a house and more about living without fear. But that would require political will, institutional courage, and cultural change. The deeper truth behind mortgage stress isn't just about money. It cuts to the core of how Australians see themselves, what they've been told to value, and what success is supposed to look like. For generations, buying a home was more than a financial decision. It was a rite of passage, a cultural milestone, a sign that you'd made it. The house wasn't just bricks and timber. It was identity, security, and status rolled into one. Owning property was how Australians built wealth, planned retirement, raised families, and passed something on. But what happens when that dream becomes a burden? When young couples realize they bought at the peak and now can't keep up? When older Australians are still carrying mortgage debt into their 60s and 70s? When doing everything right, saving, buying modestly, staying employed, still leads to stress, sacrifice, and uncertainty? This isn't just a housing problem, it's an emotional shift, a national reckoning. The dream hasn't vanished, but it's no longer comforting. It's become conditional, fragile, and for many, unreachable. And now, millions are starting to question something once sacred in Australian life. Was it really worth it? Or have we been sold an illusion we can no longer afford to chase? If there's one thing Australians are known for, it's resilience. We've battled fires, floods, and financial shocks. We get back up. But mortgage stress requires a different kind of courage. The courage to speak openly about money, to challenge the system, to demand better from leaders, lenders, and planners. Because housing shouldn't feel like a life sentence, it should feel like a home. And in the Australia of the future, perhaps the real dream won't be about owning property, but about living free from the fear of losing it. Thank you for watching. Let us know in the comments. Have you felt the squeeze? What changes do you think need to happen? And if this story hit close to home, you're not alone. Not by a long shot.